Hello and good morning, everyone. On behalf of the partners and staff of Deloitte, I especially welcome you to the 2024 Tax and Regulatory Outlook Program. This is our annual program or event that gives us opportunity to interact with you and to share perspective on tax and regulatory changes that you need to be aware of, and also to guide you as to how you go about your business activities during the year. As you may be aware, 2024 budget statement was read in November, and it came with some fiscal initiatives, including tax policy changes. Most of these changes have been now passed into law. You would also notice that as compared to 2023 fiscal year, there were more new taxes or increases that were introduced. The 2024 tax policies came with more of revenue enhancement measures and implementation of some incentives targeted to specific sectors of the economy. You also be aware that one of the challenges that businesses in Ghana face has been the consistency or certainty with regards to tax policy changes. And it is worth mentioning that the government has issued a medium-term revenue strategy to guide tax policy changes for the period 2024 to 2027. We believe that when this is implemented as planned, it will help to improve the ease of doing business in Ghana and also give taxpayers some level of certainty with the changes that they should expect in the coming years. I therefore encourage you to participate fully in these discussions as we discuss major regulatory and tax changes that will impact your business this year and the coming years. Please do participate and enjoy the program, and we will encourage you to continue to participate in our webinars, and also we'll be sharing our tax alerts with you, and also please join our Tax Academy as and when it comes up. At this point, I want to welcome our moderator for the day, John Kusi. John, over to you.
Thank you, George, for that warm welcome. And I welcome you all, ladies and gentlemen, to the 2024 edition of our Tax and Regulatory Outlook webinar. So over the next 2 hours, we are looking forward to having an educative session where we share views and have discussions on the key tax and regulatory updates as George has mentioned. So before we proceed, kindly allow me to share a few housekeeping rules for the purpose of our interaction today. So as you would have realized, the webinar is being recorded, and the recorded version will be available on the Deloitte YouTube page. So after the session, if you don't have access to the recorded version, you could visit the Deloitte YouTube page and you could have access to the recorded version. As we progress along with the discussions, if you have any questions, please feel free to drop them in the Q&A chat box, and then we'll do well to pick up your questions and respond to them. But then, to minimize distractions, all participants have been muted. When we get into the Q&A session, if you have any specific questions that remain unanswered, you could raise your hand and you will be allowed to ask your question, and we will respond to them. Thank you once again. And as George mentioned, my name is John Kusi, a manager with the Tax and Regulatory Unit of Deloitte Ghana. So let's get into the discussions now. As George mentioned in his introduction, we had the minister present the 2024 budget statement to Parliament somewhere in November 2023. And in that budget were a number of policies government intended to implement in the 2024 fiscal year. Following the presentation, we've also had Parliament pass some acts to make these policy proposals effective. So we have seen an amendment to the Income Tax Act. We have seen an amendment to the Value Added Tax Act. There has been an amendment to the Excise Duty Act, the Customs Act, the Stamp Duty Act, and then the Exemptions Act. And this year, we've had an introduction of a new act, which is the new kid we have on the block now, the Emissions Levy Act. These acts became effective and the GRA started implementation on the 1st of January. So for the purpose of our discussion, we are going to follow this outline where we look at what the recent amendments are from a direct tax perspective and an indirect tax perspective. It's critical we look at our regulatory landscape as well. So as part of our discussion, we look out for the key changes we should expect within the 2024 fiscal year as far as the regulatory landscape is concerned. We pick on a few key tax points that you should note as taxpayers and as businesses within the 2024 calendar year. And then we can't end the session without looking at what the 2024 tax and regulatory calendar looks like. So we'll end our session today by looking at the 2024 tax and regulatory calendar. And to go through this discussion with me, we have two gentlemen and then two ladies from our tax and regulatory unit. So I have Gideon Ayeowu, who is a partner with the tax and regulatory services unit. I have Betty Oche, who is a manager and works out of our global employer services unit. I have Joachim Owusu-Afiye, another manager with the tax and regulatory services unit. And then Na Ajay, who is a lawyer and then works out of our regulatory unit here at Deloitte, Ghana. Welcome, ladies and gentlemen. We can start off with the direct tax amendment and look at what the key change has been as we look out for the 2024 fiscal year. And for the income tax amendment, we've had Act 1111 passed into law. And what the Income Tax Amendment Number 2 Act does is that it revises the graduated tax rate for resident individuals. And the purpose is to align the tax-free chargeable income to the national daily minimum wage, which is something that the minister mentioned during the presentation of the budget. So let me come to you, Betty, if you can give us an explanation as to what this amendment means for individuals and for businesses as well.
Hi, John. Okay, yes, thank you very much. Yes, indeed, the tax rate has been amended in line with the increment in the daily minimum wage as indicated from 14.88 to 18.15 Ghana cedis. Okay, so it means that in effect, this increases the tax-free amount as in the first band, the nil rated income. So for the first 5,880 Ghana cedis, this amount isn't taxable, or it's taxed at 0%. So with the increment in the daily minimum wage, it means this tax band effectively has to be increased to account for the increment in the daily minimum wage. So that's essentially how this would impact the individuals. And this translates into a tax saving of about 4.44 Ghana cedis, right? It's a little marginal, but it would be, there's a slight movement within the tax band from 17.5% to the 25%. So a little bit more has been pushed from 17.5 into the 25% tax bracket, right? So there would be another marginal increment in the taxes that the individual would suffer, but it's not by much. However, when the amendment was assented, right, and we got hold of the document, we noticed some slight error in the amount or the figures. So when you look at the rates as presented, the chargeable income tax bands, right, the last amount exceeding 600,000, all the previous tax bands is supposed to add up to this last line. Right. However, when you add these figures, you are getting a little bit more than that. What you are getting is 605,000. So it means there's a slight error in there. And then we have drawn the attention of the GRA to this fact, and they have also gone back to the lawmakers, the parliament, to probably amend this act or rectify it. And so we are actually on hold with these rates and pending further amendments to it. But as far as we know, and from the recommendation of the GRA, this is a law that has been passed, and so we have to go by it. And so essentially for the month of January 2024, this is the tax band or the tax rate in effect. And so we have to go by it, and income tax has to be withheld according to this tax band. If and when the amendment is passed and there's a need for any adjustments, then that could be done. But for now, this is what we have in place. Yeah.
All right. Thank you very much, Betty, for that comprehensive analysis. And for me, the exciting aspect, it's although marginal, the reduction in how much tax people would have ordinarily paid, given the amendment to the national daily minimum wage and then amendment to the graduated rate as well. Thank you, Betty. So let's move into the amendments with respect to the indirect taxes. And in 2024, we have seen an amendment to the VAT Act, and it made some critical changes to the VAT landscape in Ghana. So maybe I'll come to you, Joachim. Let me pick the first amendment, which is the introduction of 5% VAT flat rate on the supply and rental of immovable property. So with the passage of Act 1107, supply or rental of immovable property by taxable persons is to be subject to VAT at 5%. And the supply of immovable property by real estate developers also subject to a VAT flat rate at 5%. So Joachim, from where you sit, if you can help us understand what exactly this amendment is and whether there are any specific exclusions we should take note of.
Right, George, thank you very much. So if we follow that maybe lane, we will realize that there have been previous amendments on supply by real estate companies, brands, and all those. So this is kind of bringing another leg for the application of flat rates in respect of rental or supply of home properties. So what this amendments law has done now is that for all commercial rentals, which is not for dwelling or commercial rental establishment, I will take my time and explain the difference between the two. You charge VAT at a flat rate of 5%. And if that supply of immovable property is done by an estate developer, then the same 5% will apply. Now, the difference between the first category of suppliers, 5%, and the real estate developers is that for the first category of suppliers, the 5% only applies when it is rental. So think of it like you go and rent a warehouse, right, where you store your products. It's a commercial rental. It's not a rent that is for dwelling. You don't stay in that. And it's not an accommodation for, or it's not a commercial rental establishment. Typical commercial rental establishment look at businesses whose the nature of business is that you need a room to stay in. That is their business, commercial rental. So we can talk about the hotel, those who run hotel, how do you call it? Hostel for students and all kind of people. So those kind of rent come under commercial rental establishment. So if you rent it, so let's say offices, if you have offices that you are renting out, your company has extra floor that they rent out. Remember, your company is not a real estate company, all right, but they have extra floor that they are giving out for rental purposes. In that case, you will charge rent at 5% in this. Now, for the real estate companies, either you sell or you rent, you charge rent at 5%. So we just take note of that. If your company is not a real estate company and they sell an immovable property, which can be a land or a building, right? If they sell it, they will not apply VAT of 5%. They will apply the standard rates VAT of 5%. So, John, that is the clear distinction between the two. But I believe there are other implications as well, which quickly I want to touch base on. The general concept about the flat rate scheme is that you are not entitled to input that deduction. So this will be a significant change in terms of your VAT accounting. If you used to charge standard of 15% plus the levies, and you were claiming input, going forward, you will not be entitled to claim input if you make such supplies. And for real estate companies, they will not be entitled to input claims, both in terms of rental and sale of in-work properties. So John, that is just a quick overview of the first.
Okay, Joachim, thank you. So the denial of input VAT deduction would mean that cost of VAT incurred on purchases will now be passed on to consumers as part of the prices for these immovable property. Okay, let me pick your thought on this one as well. So for taxable persons who rent out these facilities, what we know is sometimes they provide other incidental services to the people occupying these facilities. For invoices covering these incidental services, should that 5% flat rate apply as well?
No, so interesting. What is incidental service or incidental supply for VAT purposes is a technical word, but you can't have services incidental to a service as per the law. So it's a different kind of service. And typically, businesses those who run the mall businesses, typically they do provide this kind of service. Or those who generally provide real estate companies who provide office space. So they will build it and they will run it as well. So if you can't be able to fix what to do any fittings in it, they will do that. They are responsible to ensuring that there's power, there's security. So all those services, they are different kind of service, but for what purposes, they don't qualify as incidental services. And since the payment is not for rent, it will be treated separately as a standard retail supply, which will be subject to VAT at the standard rate of 15% plus the levies. Now, that gives another angle in terms of input deduction. So it means that you're going to incur input tax potentially for service for the renter that qualify for 5%, and for other services that will be subject to VAT at the standard rate of life. So businesses here, our advice is that, or recommendation, businesses here must ensure that the appropriate allocation is done for the standard retail supply, so they can claim tax on it. And input cost that are specifically incurred for the other services, proper documentations are kept to justify the deductibility of sale.
Okay, all right, Joachim, thank you. And we have one question from Emmanuel. Emmanuel Ashite wants to know what the percentage of VAT would be for rental of warehouse. So Joachim, if you can pick that before we move on. So for rental of warehouse, what then should be the VAT rate applicable on that?
Yeah, so rental warehouse will be 5%, whether by real estate company or any other person, that will be 5%.
Okay, all right, thank you. Thank you very much. So as we go along, let me just remind, if you have any questions, you can put it in the Q&A chat box, and then we'll do well to respond to them. Gideon, let me come to you and pick your thoughts on these two other amendments we have seen in the VAT Act. And the first one is the classification of the supply of non-life insurance as a taxable supply, and then the supply of domestic air travel. So what this means is now persons supplying these products will be required to charge VAT at 15%. So Gideon, for such entities engaged in such supplies who were hitherto engaged in exempt supplies, what should they do? And then broadly from your view, what is the implication of this new amendment as well?
Okay, thank you very much. Thank you very much, John. Yeah, so all these changes or amendments to the law are parts of government's attempts to increase revenue. So whenever you see any of these changes, you should ask yourself, what does it mean? How much more taxes am I going to pay? And I think for the insurance industry, the ones mostly affected, of course, you can see the non-life insurance. Is it fortunately or fortunately, because of how the Insurance Act operates, all non-life insurance are conducted in a separate, distinct business against the other life insurance. So it's much more clearer for the non-life. And what this is doing then is that previously, we had a section in the VAT Act which says it's exempt. As listeners would know, the way VAT applies, that it's specific, but then there have been certain exemptions. So if your service or your name is there, it means you're exempt. And so previously, financial services as a whole was put there as an exempt. I don't want to go back to the history to see the changes and so on, but recent history, 2 or 3 years ago, we know that financial services have been exempt. However, what this change has done is that it's taking out the non-life insurance from this exemption. So it's a negative, which means that it's going forward, non-life insurance will be subject to VAT. And what this means that for all the insurance companies previously, because they were in a certain sector, they might not have been registered. If they are not providing any taxable supply. But this change means that now they have to go ahead to the GRA and register their business. That's for the non-life insurance and start charging VAT. However, with them, the law is not, it's a bit complex as to the deductibility or otherwise. It's not as straightforward as in the normal businesses where you're able to deduct and say, well, I made a purchase of goods and services and so on, and I get to deduct this amount. With the change, it's been very recent, but a certain level of schools of thoughts have developed around the deductibility of the input VAT for all this non-life insurance. A specific point I want to raise that is whether, for example, one of the schools of thought is that based on how the law has been written, for an insurance company, although you start charging VAT whenever you sell your insurance policy or contract, when it comes to the VAT, one of the schools of thought that has developed is that they can only deduct when a claim or they make an indemnification to a policyholder. It's still developing. We are looking for guidance and still looking at how it's going to develop. Others are saying that no, we still have to look at the other goods or services purchased. But one thing I want to put out to all the attendants here is that it's still not clear. We are looking for guidance, especially when for the insurance companies is going to start applying, because I know the registrations have to be completed. They also have to start charging the VAT. And I understand there's some level of interaction between the insurance association and the GRA. And so by the time this is done, I'm sure maybe end of this month or early February, and we would have a lot of clarity as to how this is going to pan out. The third point I also want to mention is on the domestic travel. So similarly, there was a wide exemption under the VAT Act for some type or for a lot of these domestic travels, whether by road, rail, water, etc. I think the exemption was, or the exclusion was for haulage. What this has done is that the wording has been changed. So now domestic air travel would also be subject to VAT. Once you come under the VAT, there's a positive and a negative. The positive means that once you start charging VAT, you are allowed to clear part of your costs in terms of what you purchase through the VAT mechanism, the output and the input. So you charge on what you sell, and then whenever you make purchases or payment meeting certain conditions, allowed to set off, and then you don't pay everything to the GRA. However, what this means is that for the end consumer or the users of these services, especially if you're an individual or you're a business that cannot claim VAT, this becomes an additional cost to you. It means that you can't claim. Unfortunately, to another addition is that for us in Ghana, the way our VAT law operates is that you have an extra 6%, which we all know to be the COVID levy, the health insurance, and the GET fund. This 6% becomes an additional cost to you, the service provider, and also the end consumer. So although the VAT law says that you can claim your normal VAT, because of this additional 6%, it creates a cost on cost. So whilst you are charging VAT, you have to charge VAT after you've put on this 6%. And that's why I think recently I saw something on social media going around that although the VAT Act, for example, says 15%, in actually effectively you are paying 21% because of how the VAT laws applies. So you see the 15% here, you see the 5%, and I'll come to the 5%. Joachim has talked on that, but also want to touch another clarity we are seeking from the GRA is how this 5% would apply, whether it will come after the VAT, the normal levies, or whether because the flat rate that will be excluded, or what will be done to the 3% that only 1% will be charged. So it's still developing. These are the general outcomes or the general structures, but we expect a bit more deliberation and some final clarity so that it doesn't negatively affect businesses. Over to you, John.
Okay, right, Gideon, thank you. So just two quick questions, one from Al-Hassan and then one from Michael. So Al-Hassan is asking whether with the introduction of this VAT on insurance premiums, what it means is the premiums would increase for the final consumer, which I would expect to be so, because once the VAT is the consumption cost and it's to be borne by the consumer, once the insurance companies charge that VAT, it means all things being equal, the premiums we are going to pay would increase. But maybe this one, you can take this, Gideon. Said that Michael says, I understand that is to be calculated on the redemption of the claims and set off against the VAT paid on the premium paid. Gideon, can you help explain that?
Yes, I think he's trying to, one of the views I shared in terms of how the input deduction is going to be done. It's on the input itself for the insurance company or the non-life insurance companies. For the person making the claims too, for then, yes, it also has an impact on you as to how you do the deduction. So, Michael, yes, you are almost spot on. And as I was saying, there's a certain developing schools of thought as to specifically how it's going to apply. Because of the fact that, well, are they saying that the insurance, non-life insurance can only charge on the premium and then they can only get the deduction when there's a claim, and that when there is no claim, there is no input VAT at all? Or is the inputs here, as the law talks about, only when it comes to the claiming by the policyholder, but then on the normal business or day-to-day transaction, they can also claim just like any other business does. So what we are looking for now, as I'm saying, because it's a new law, people have looked into it now, and some of these questions are coming up. In-house, we've talked to all the experts and we've tried to come up with collecting the various views. So not fully stuck out yet, but it's still an area in progress.
Okay, right, Gideon, thank you. And then one question that seems to be running through the questions we have from participants is what the VAT rate would be for the non-life insurance product and then the domestic air travel. So they will be treated as standard rated supplies. So the rate would be the standard rate of 15% charged together with the levies of 6%. Okay, so beyond these amendments we've spoken to, there has also been a revision to the list of supplies that are exempted from VAT. And Joachim, I'll come to you on this one. So we've seen the introduction of an import VAT exemption for electric vehicles imported for use in public transport. We've also seen the exclusion of some selected printed materials from the list of supplies exempted from VAT. And also, there has been a modification to the VAT exemption in respect of the supply of input for agricultural purposes. So Joachim, you can help us understand what these amendments are. And then once at it, maybe you can add if there are any specific compliance obligations suppliers should take note of.
All right, so thank you very much for this. Right, so for import exemption on electric vehicles, we all know the green agenda, how our environment is being polluted, carbon dioxide and all that, polluting the environment and all that. So globally, all countries are taking steps to promote the use of green-friendly assets, including vehicles. So electric vehicles have come on the horizon. A lot of businesses and countries are promoting the use of electric vehicles over fossil fuel vehicles. So this is, the government way to promote the use of electric vehicles in Ghana. If you import, then you get import VAT exemptions. That the effect is significant. If you look at how our VAT system runs, like you mentioned, effective rates plus the levies are 21.9%. That is almost 22%. So this exemption is intended to encourage more people to buy electric vehicles. So if you have plans of buying any vehicle, please consider electric vehicles. Of course, there are concerns around whether Ghana will be ready. We have the infrastructure, we have the right infrastructure to ensure people can use electric vehicles in the country. Some are using it, and I believe they can all try this. So this is just to promote the green environment. Now, exclusion of selected printed materials. So this is another policy to promote local production. Practically, the law is seeking to exempt printed materials that are imported, right? So it includes textbooks, exercise books, newspapers, publications, charts, drawings, scientific and technical. So a lot of them. So all the things that would typically be printed for us to read, if you import them, then it will be subject to previously it was exempted, but now the law is seeking to bring them into the scope for taxability. So if you are in that business, brace yourself for additional taxes that you pay at the port when you import these things. And then when you sell subsequently locally as well, you need to charge them as well. So if in your business you buy some locally and you import some, you need to get a distinct reporting system to ensure that the ones that import, you're able to identify them and charge the right VAT and levies on them for subsequent. So, and then for modification to exemption instead of input for agricultural purposes, the law just making specific reference, promoting agriculture, right? It's the backbone for our industrialization. Okay, so it has to only be for agricultural purpose and to be specific or designed for the purpose of agriculture. If that equipment has multiple uses, then you may have difficulties getting the relevant exemptions when you import those inputs. So John, that is my thoughts on these exemptions.
Okay, Joachim. So thank you. And then one important point we'll be looking out for once the GRA issues administrative guidelines on these amendments would be what form of evidence suppliers should keep to support the treatment of supply of such inputs as exempt supplies. So how do you justify that indeed this sale of this input, the customer is going to use it mainly for agricultural purposes? And that's one thing we'd expect the GRA to clarify once they issue an administrative guideline on these amendments that have been passed. And we've also seen a revision to the zero-rated supplies. Now we have the supply of locally manufactured sanitary towels being zero-rated for VAT purposes. And this is in line with the proposal the minister made when the budget was presented to Parliament. We've also seen an extension of the zero rating of locally manufactured textiles and locally assembled vehicles by 2 years, which means up to 2025, December 2025, supply of locally manufactured textiles and locally assembled vehicles will continue to be subject to VAT at 0%. So, Joachim, maybe let me take your quick thought on this. So, especially for suppliers of locally manufactured towels who are now going to be treated as zero-rated suppliers, would there be any specific change, especially with respect to input VAT deduction?
Right. So thank you, John. And let me just mention that it is quite specific that it is for only locally manufactured sanitary towels. Right. So if you are selling imported, you are required to charge the VAT, and you'll be subject to import VAT as well when you import those things. So it just promotes local production. I think the data shows that at least we have companies that are able to manufacture a significant part of the cider towels we need for use in the country. So it's just to make the local production cost more competitive, so businesses can stay afloat and compete with imported product. Right. So now, John, it is zero rated. Now, the good thing is that zero rated doesn't mean it's exempt. So when zero rated, you are still entitled to input that deduction when you supply these sanitary towels. If it was exempt, then you don't get input that deduction at all. The effect is that the input tax can be claimed, and that should not affect the prices eventually of the sanitary towel that will be manufactured in the country.
Okay. All right, Joachim, thank you. So one last amendment we saw in Act 1107 is the introduction of a penalty regime for withholding VAT agents. So under Act 1107, withholding VAT agents who fail to withhold VAT on payment to standard rated suppliers would now be liable to pay the VAT they failed to withhold. And in addition to that, the introduction of a penalty of 30% of the amount that is payable. So although the law provides an opportunity for the agent to recover that amount of VAT that was not withheld from the supplier, the downside is the penalty imposed is not recoverable, which means for withholding VAT agents, it is critical that our systems are properly calibrated so the right amount of taxes are withheld and then they are remitted to the Revenue Authority on a timely basis. So now let's move into the Excise Duty Act, which has also been amended. So principally, we've seen amendment to the schedule, which contains the list of items that are subject to excise duty. So Joachim, maybe you can assist, take us through what the changes are and the implications from these changes.
All right, thank you, John. In respect of the first one, imported plastic and plastic material, previously, excise duties were only applicable on local manufactured plastics, right? And clearly from a competition perspective and from an industrialization perspective, that was fair to local businesses who have set up to produce plastics. Right, I know excise duty sometimes it is imposed to discourage consumption of certain products, but it is also a revenue generating activity, and businesses go into that business to make money, employ people. Yeah, so it has four effects if you want to look at from that perspective. So, not taxing imported plastics was a disincentive for local production. What this amendment has done now is that expanded the scope to include imported plastics and plastic materials, but has now reduced the excise duty rate, which was originally 10% to 5%. So previously, for local plastic products, the excise duty rate was 10%, but with the expansion of the scope, the rate has fed now together at 5%. Now, there's a question of couldn't government have rather, if you want to encourage local production, maybe reduce the local production rate to 5% and maybe maintain that 10% for the imported raw materials. But that's what the amendment is to expect at 5% with clarity now. Once you import, the 5% will still be charged on it. Then John, on cider beer. Cider beer, if you look at local manufactured beer, similar to the practice and price match, local manufactured beer, the excise duty rate was 47.5%. But when we import cider beer, the rate was 20%. So why are we taxing local production, more than imports? So what this laws amendment seek to do is to align. Now cider beer is also 47.5%. The implication again is on pricing. The import cost will increase, and if suppliers want to, transfer all the cost to consumers, then we should expect some increase in the price of cider. So if cider beer is your thing, please budget a little bit more in your next pages.
Okay, all right, Joachim. Thank you for that as well. So beyond the Excise Duty and the VAT Act, we've seen an amendment to the Customs Act as well. And what that amendment specifically is an amendment to the First Schedule, and which has introduced an additional 431 tariff descriptions to the customs tariff. And in line with government's objectives to make the prices of locally manufactured sanitary towels cheaper, there have also been an introduction of waiver of duty on the importation of raw materials that are used in the manufacturing of sanitary towels locally. We've also seen an amendment to the Stamp Duty Act, and the specific amendment is the increase in the rate of the stamp duty, and we've also seen an expansion in the scope of instruments that are subject to stamp duty on an ad valorem basis. And then there has been an amendment to the Exemptions Act, and specifically, this amendment covers the waiver of custom duties and taxes for imported fishing gear for agri purposes. So once importers are importing fishing gear and the purpose is mainly for agri purposes, there is a waiver of custom duties and taxes. And this is subject to the approval of the minister responsible for fisheries and aquaculture development and the minister responsible for finance. And the new kid on the block I mentioned, which is the introduction of the Emissions Levy Act. And what this act seeks to do is to impose an emissions levy on the carbon dioxide emissions from specified sectors. So the law is focusing on the construction sector, the manufacturing sector, the mining sector, the oil and gas sector, and then electricity and heating. So the expectation is players within this sector have a lot more carbon dioxide emissions. So this law seeks to impose a levy on their emissions on a monthly basis. And for individuals and users of vehicles, the act also imposes an emission levy on internal combustion engine vehicles emissions. So for you and I and anyone else who uses a vehicle that runs on fuel, the passage of this law means that on an annual basis, will be required to pay an emissions levy. So that is what this amendment seeks to do. So thank you, Joachim, Gideon, and Betty. Let's check the regulatory landscape as well. And within the regulatory landscape in 2024, we are expecting an amendment to the Ghana Investment Promotion Act. And we've cited the bill. And now let me call on Jay to walk us through what the key changes are expected based on the bill that have been received. Okay, so now if you can help walk us through what the key changes are.
Thank you, John. Okay, so the Ghana Investment Promotion Center Act, currently there's a proposal to amend some provisions of the act, and there's a bill in place that has been put before Parliament for consideration and passage. We've noted some few amendments which we believe are important for businesses to be aware of, and we'll discuss and later take your questions after this brief discussion. So the first proposed change is to upgrade the status of the center to an authority, which will grant it more autonomy in terms of the actions or the scope for which it is set up. Its scope is also being expanded to include the registration of all businesses in Ghana or enterprises as they are noted in the Act in Ghana, and to promote the development of investment in Ghana. Another key proposal is in terms of the registration and renewal with the center. And currently, the registration with the center has a duration of 2 years, and it's renewable every other year. The proposal is to make the renewal annual going forward. So once this law is passed, businesses will need to update their compliance calendar to ensure that their renewals are updated every year. Now, another key a very important proposed amendment is the elimination of the requirements to provide a minimum capital when setting up a company. Now, entities that have foreign participation in terms of wholly owned foreign companies or partly owned, jointly owned with the Ghanaian citizen are required to meet minimum capital requirements upon registration with the center. Currently, for wholly owned foreign entities, they are required to register a minimum capital of 500 United States dollars. And for joint enterprises with a Ghanaian partner, they are required to register with a minimum capital of 200,000 United States dollars. Going forward, if this law comes, it's passed, there's this requirement will not be necessary. So any business or any individual, a non-citizen who intends to set up an enterprise in Ghana may set up without bringing in this capital, be it in cash or goods, or a combination of both, or by showing their equity participation. So this is in the right direction, which is opening Ghana up for business and for investors. Because in our experience, this has been a hindrance to some businesses which are seeking to set up in Ghana. Now, the requirements, let me just quickly update that the requirements for registration in the current act does not explicitly apply to branches, but the GIPC has enforced the rules to indicate that branches or external companies are required to register with the center. This is being sought to be codified in the amendment, which will insist that all external companies should register with the center before they commence the business for which they were set up. Now, another key update is the removal of activities which are reserved for Ghanaians. In the current act under Section 27, businesses such as the setting up of hairdressing salons, barbershop, operating of taxis, printing of excise books are reserved fully for Ghanaians. Going forward, non-Ghanaians can participate in these businesses. There's, however, a caveat that for trading, it still remains that a non-citizen that intends to set up an enterprise to engage in trading is still required to meet the minimum capital requirement of 1 million USD. So that has not been taken away. Another proposed amendment is the revision of the duration of a technology transfer agreement, the registration period. Now, currently, the first registration of a technology transfer agreement may be up to a period of 10 years and renewable for subsequent periods of 5 years each. The proposal is to reduce this initial registration period to 5 years and renewable for subsequent periods of 5 years. Another rule that, or should I say, an offense that was not specifically stated in the current act is the offense of fronting. The new proposal states exactly what fronting means and states that it's an offense for a non-Ghanaian to represent, to set up a business which in fact is actually owned by the non-Ghanaian, just to circumvent the requirements of the act. There's another provision which is quite interesting, in which this proposed amendment is seeking to put a restriction on allowance of deductions for cost or payments for services received under a technology transfer agreement, which is not registered with the GIPC. Now, this provision is arriving out of a vacuum that was realized in the appeal case of Based-Off Ghana against the Ghana Revenue Authority, in which the court held in that case that the right to deduct or to deduct for tax purposes the fees paid to the service provider cannot be restricted, which GRA sought to do in that case. And therefore, currently, a company can deduct or is allowed to deduct those expenses it incurred for payments of such services, even if the agreement under which it is seeking to make the deductions is not registered with the GIPC. Now, the issue is this is purely a tax regulation, and the way it's being introduced in this particular provision or act as a way of curing that that defect that the court noted in that case is quite interesting, and we'll see. We hope to see how this will play out if this law comes into its passed, or if it actually makes it into the passed amendment. So these are the key highlights we have noted that to look out for if this law is passed and comes into force.
Okay, now thank you for that. And then maybe I'll pick on the last change you mentioned and pick either Gideon or Joaquin's view on it. So the case now made reference to the Baisdorf case, taking into consideration the conclusion of the court in that case. Should this bill be the appropriate place where we seek to restrict the deductibility of such payments, or would it have been more appropriate to have it in a separate amendment to a separate law? So maybe Joachim or Gideon, if you could share your thoughts on that.
Okay, let me take it. All right, John. So it's quite interesting. We all get the idea. It appears there have been some discussion between TRA and GIPC and the effect of that ruling. It looks like it's not a ruling that the TRA or the GIPC was really happy with, but that is the ruling. And it was quite clear that GRA cannot implement a law that is applicable to a different authority for the purpose of tax assessment. So the ruling was quite clear on this. So to still now make clear provision in the GIPC Act, which is not a tax law, and if the intention is for GRA to implement it for tax assessment, then I don't think that will be consistent with the ruling of the court. So I think that implementation will have challenges. GRA will have challenges with implementation, because it does not really change anything. If compared with the old law, it does not really change anything. The underlying principle of the ruling is that GRA, you cannot use GIPC Act to administer a tax law. And this provision is in the GIPC Act. So the underlying principles are the same, even as you speak. So if the idea is really to place emphasis and give relevance of this provision for tax assessment, I think maybe the right forum GRA could have used was to directly amend the Income Tax Act to include these requirements as a condition for deductibility. Yeah.
Okay, Joachim, thank you. Okay, Gideon.
Yeah, just to add a bit to it, and this is also an issue for me, which has been ongoing for a while, for the fact that we had this technology transfer agreement in Ghana at a time when we didn't have transfer pricing regulations, or in those times, it wasn't so topical. A lot of countries didn't have it. So the TTAs were put in place to sort of regulate this related party payments and transactions. We all know that since 2012, Ghana has had transfer pricing regulations. We recently amended it. And so the thinking was that once the transfer pricing regulations came into force, the TTAs would be done with, because in actual fact, they do tend to conflict in terms of what they stand for, what the TTA stand for, and what the transfer pricing stand for. But for some reason, for a while now, we've had the two side by side, and it's causing issues. And these are some of the issues which will keep on coming up because they are almost addressing the same things here, but we have different regulatory bodies trying to oversee it. And I think it's time that the authorities take a step forward and then come out and say, well, we've recognized this thing for a while now. It's been under 2 different institutions, and it looks like none of these governing bodies is prepared to let go. And I think this rightly GRA's mandates, and they should be allowed to go on with it, whilst the GIPC also goes ahead with its own mandates to regulate other areas, and not when it comes to related party transactions. Thank you.
Okay, Gideon, thank you. So I think the intent is quite clear, although we are raising concerns around which act should be making provision for the deductibility of such expense. So for businesses that do have such TTAs that are registrable but are yet to register them, I think it is the right time to initiate processes to have these agreements registered with the GIPC. We have seen this in the bill, whilst we raise concern about whether that is the right bill to even contain this document. It just communicates what the intent is. So it would be right for businesses to take the necessary steps to be able to register such TTAs they have that are supposed to be registered with the GIPC. Okay, so now we move on to look at other key tax points that taxpayers should take note of in this 2024 calendar year. And I'll yield the floor to Joachim and then Gideon. Once we talk through the business tax issues, then Betty, you can come on if there are any specific employee income tax areas, then you could also share that as well. So maybe Joachim, I'll start off with you. Then Gideon can come in to share some perspective as well before we have Betty giving us some comments around the employee income taxes as well.
All right, thank you, John. So, non-deductibility of unrealized exchange losses and realized exchange losses from transactions between related parties. So, the Amendment Act, which was passed last year, so this affects 2023 year of assessment. It was implemented around May, or so that it became effective. So from May to December, then these provisions would apply to you. Now, it's the amendment introduced some tier of deductibility, right? If you incur foreign exchange losses, realized or unrealized on local transactions, you are not entitled to any deduction. So that's the first step. Any exchange loss you incur, the first question you ask, is it incurred on local transactions? If your answer is yes, it ends there. Disallow the entire amount to pay full tax on it. Now, if it is not but incurred on foreign transactions, then it counts into 2 folds. Is it realized or is unrealized? If it is not realized, you don't get deduction for it. But if it is realized, then you get deduction for it, but subject to the restrictions under the income tax. So the restriction here means that the extent of deductibility shall not exceed foreign exchange gain and 50% of your adjusted taxable income. So that is the level that you need to go to determine what exchange, foreign exchange loss you get that you can deduct, right? Now, John, let me also touch base on the use of GRA certified invoice as a base of expense deductibility. Yeah, this was also mentioned in the budget proposal. And as we know, there are GRAs currently working on implementation guidelines in terms of how it should be implemented. But this has come with a lot of concerns. I remember we came to see this, I think 2022 or 2023, somewhere around that time, where there was an internal memo by the GRA for staff to implement. But then when it came out that the policy that was raised, they put a hold on its implementation. But I think now it's bold now that's come up with the budget. So the GRA is taking the step to implement it. The concern here that people have raised concerns about the legality of this implementation, linking that to the Madoff case, that hey, you cannot use a different law to administer the tax assessment, for example, the respect of income tax law. So where specifically a VAT invoice is required to determine deductibility, are we not relying on the VAT law to implement CIT, or income tax assessment? It's a general question that has been raised. There are two positions on that. Some say the PRA has powers under the Revenue Administrating Act to issue such guidelines that the Commissioner General can, prescribe what an invoice looks like. And in the view of the Commissioner General, an invoice should be a VAT invoice. So be it. That's why it should be applied. But of course, the concern also raised by the legality bit and whether or not only a VAT invoice can determine expense deductibility is also genuine, which should be addressed. I know the GRA practice notes draft one is not out yet. Concerns around how will I know that somebody supplying this to me should charge VAT? First of all, is the person actually VAT registered? How will I know? VAT registration is based on one, the transaction to be a taxable transaction, and the person making the supply should have registered or is registrable to charge the VAT. Registration threshold is just 200,000 in any 12-month period. So, may the person buy, how will I know the person is registrable? And this is a genuine concern that we think should be addressed by the GRA to bring more clarity. And not all expenses, clearly business expenses, are subject to VAT. If you procure government services, government will not charge you VAT, but they are all genuine business expenses that you should be able to deduct. We believe that the practice goes to address all these concerns. So it has one purpose. You can see that the underlying principle is to promote VAT compliance, right? Using an indirect way to promote VAT compliance. But I believe that GRA should not push too much burden companies who are doing genuine business, carrying genuine expenses. And because we want to promote VAT compliance, it becomes an additional burden to deny them, deduction of expenses for the purpose of CIT. So John, maybe if I have questions, I will leave it here. If you don't have comments, you can come in to speak on that.
Okay, Joaquin. So we'll allow Gideon to share his views as well, and especially in respect of levies on imported services. So we know court rulings are part of the sources of law in Ghana, and we've had a recent ruling with respect to levies on imported services. So if Gideon can shed light on that as well in providing his comment, that would be very helpful.
Okay, thank you. Yes, you've rightly mentioned. So what we saw, we've seen the past couple of years, and we expect to continue seeing them, is that there's quite a number of cases now going to courts, finding their ways into courts than we previously used to see. So we even have a number of cases which has gone to the High Court, it's been appealed, it's gone to appeals courts, and we're even hearing some of these cases are going to Supreme Court. So this is very good on the part of the revenue authorities and also taxpayers, and testing the laws and seeing how the laws should be applied. One of these areas we saw recently, end of last year, and it's come out now, and I don't think a lot of entities have seen it or taken action on it. It involved a telecommunications company and the GRA. And this involved what we used to call, or what we call, imported service. And so where you are in Ghana here and you get services provided by a foreign entity, as compared to maybe importing goods, the services is provided by foreign entity in abroad or non-residents outside, and then it is consumed and used here. So we know that under the Act 896, the law was amended to make it so that you only charge or apply VAT when you, the recipient of the service here, use it for an exempt supply. It's a little bit complex, but let me say, so if you receive a service that you, the service provider, you provide normal services. So let's say you are into business of hoteling, for example, and somebody provides a service from Mauritius to you, the hotel company here, and you use it to provide your normal taxable hoteling business, then you do not pay imported service VAT. And so one of the telecoms entity took GRA to court on this issue. At the end of it, the court decided that, in fact, there were two main issues that the court decided on. One of it was that irrespective of whether you, the recipient of the service, and the example I use, the hotel company, uses the foreign service supplied in Ghana here for taxable or exempt, you are supposed to charge levies. I'll repeat it again. So the court said that you are in Ghana here, you are providing a taxable supply, irrespective of whatever you are using the service for, whether taxable or exempt, you have to charge your levies on. So, and this levy is the 6%, as I mentioned earlier, the 2.5, 2.5, and the 1. And this is quite significant. It means that if for all the services that are being imported now and you're a company and you have this sort of imported service and you haven't been charging levies, it's something that you look at. This came very late in the year and it's still being looked at, and I understand it might be appealed. But I think it's quite significant. It increases the cost of service. It changes a lot of things. And I have my own views on whether it is correct or not, but it is the law. That's what the court has decided on. The other portion, it's not so technical. It was how the company use the services in and whether they were distinct or not. And the court made a decision on that. But I think the main thing we have to take on this is the levies on imported service. It means that potentially for all the services that you will be receiving and you'll be paying, maybe you have somebody providing software services, subscriptions, etc., and then you're using here, potentially you should be charging 6% addition on this imported VAT. So that's an area that we have to look out for. The second one I want to mention is transfer pricing adjustments. Usually a lot of interrelated party transactions, and we have companies making payments for transfer pricing, payments to their related party. If you have such adjustments and it's just a general, you just decided that it's going to be 5% or 10% or 15%, whatever rate you agree or arrive on, make sure it is substantiated. What exactly goes into this 5% or 10% or 15% transfer pricing adjustments that you are making on an annual basis? If it is not adjusted, you leave yourself exposed to having a TP audit, and then when it comes out, they would ask for 100% substantiating of such an adjustment. So these two significant areas is what I want to touch on, and I think taxpayers should be aware and start making preparations or talking to their tax consultants about it. Thank you.
Okay, Gideon, thank you very much. So Betty, beyond the update we have seen to the graduated income tax rate, are there any specific points or areas taxpayers should be looking out for, especially within the 2024 calendar year?
Okay. Hi, John. Yes, indeed, there is more to it. So the tax rates were amended due to the increment in the daily minimum wage. In the same vein, the net maximum insurable earning and minimum insurable earning has also been adjusted. So minimum has been increased. When you talk about the maximum insurable earning, it means the amount that net would accept, okay, as contribution for tier 1. Okay, so previously it used to be 42,000, but effective January 2024, it has been increased to 52,000 for individuals. And then the minimum is about, sorry. So the minimum is also about 400 and, sorry about that. 490 Ghana cedis, sorry. Yeah, so this doesn't really affect the staff cost or the employer cost in any way. The movement is merely between tier 1 and tier 2, right? So in Ghana, we have the 3-tier system, the tier 1 managed by SNET, and then the tier 2 managed by the private fund manager or approved fund manager by the NPRA. So what SNIT is saying that the amount that we can insure for each individual is capped at this 52,000. And so any excess, which according to Deloitte internal practices, we recommend it's contributed into tier 2. So if you have an employee earning above 52,000 Ghana cedi salary, if SNIT is only accepting up to 52,000 contribution, or the salary is 52,000, then we recommend the excess is paid into tier 2. So it doesn't really increase the staff cost or the employer cost, neither does it have any impact on the individual by way of increased or decreased earnings, but it's just a movement from tier 1 to tier 2. Yeah, so that's for the SNIT minimum and then maximum insurable end, or the SNIT basic salary cap. Now, another point of note would be the GRA's recent, not quite recent, but it has been in the pipeline for a bit, the review of or targeting of high net worth individuals, right? So who would we consider to be a high net worth individual? There's no, or the GRA has no real defined explanation or definition for these individuals. But in the finance space, they are deemed to be individuals whose assets and income exceed $1 million US, right? So the GRA is looking into these individuals to confirm their compliance and ensure that they are reporting all their incomes, right? Now, does the GRA have the mandate to do this? Yes. And does the GRA have the right to request for information from these individuals' home countries? Yes, they do. Now, when it comes to the right to tax or subject their global income to taxes in Ghana, when expatriates or an individual is deemed to be resident in Ghana, it implies that their worldwide income is subject to tax. So it's not only the income that is sourced in Ghana, but every income received from any other country should ideally be reported and subjected to tax in Ghana. And so that is why the GRA has the mandate to get all this information in order to bring it to Ghana and then tax it. Now, another right or mandate to go to other jurisdictions for this information, which is actually in place, is an agreement that the GRA has signed on to, right? And this is the standard for automatic exchange of information. Okay, so once the GRA signed on to it, we have over 171 countries presently signed on to it. And what does that is that it's gives financial institutions, right, a requirement to report all income, assets of individuals who hold accounts with them. And so once the GRA has access to this information, and it's supposed to be an automatic annual reporting requirement. So it's not even when the GRA requests for it, but on an annual basis, all financial institutions are required to make this information available to the GRA. So with this information and information from all these other countries, the GRA has an overview of all the income that a specific individual is receiving. So if they compare that to what you are reporting in Ghana and it's not tallying, then it means either you are understating your income to be reported in Ghana, and so you would then be charged additional tax liability and potential interest as well. So how can individuals ensure they are compliant with this? So we have the annual personal income tax filing, which is due 4 months after the year end, right? So all individuals are required to file PIT, which is the personal income tax return, indicating all income received from employment, business, and investment. And then if these incomes are reported, taxes are charged on them, right? However, even though taxes are charged, individuals or residents have the room to utilize a foreign tax credit. Now, a foreign tax credit is income that is being considered in Ghana for tax, but we are saying the same income has been taxed elsewhere. And so the GRA gives you room as a resident individual to present a foreign tax credit to show as evidence of taxes paid on the same income. And so whatever tax the GRA calculates, it would knock it off against what has been paid in the foreign country. So, and this is not only limited to countries that we have the double tax agreements with the DTAs with, it's applicable to all resident individuals, whether we have a DTA with your home country or not. Yes. So how do we go be above or be compliant with what the GRA requires is to ensure that when this filing return is due, you ensure that all incomes are reported from all sources, so the GRA wouldn't have to chase you for that and then charge potential interest on it. Another aspect would be the introduction of the special voluntary disclosure program. So we are targeting high net worth individuals, but we are bringing this program. It's a proposal that is in place, and within the next few weeks or months, the GRA will probably release a publication on this. But this is some form of amnesty, right, for granting the individuals room to, on their own, disclose incomes or earnings or assets that they have previously not provided. Okay, so it then gives the GRA the right to tax this, but the benefits of being covered under this program is that any interest or penalties are dropped or disregarded. They wouldn't charge any interest or penalty on the tax liability. Whereas if you don't enroll under this and then the GRA embarks on its own checks and then finds out you have undisclosed income, then it means potential interest would be charged on any tax liability. So this would be enrolled within the next few. And so we are entreating all individuals, expatriates and all that to ensure that once the filing application is due, they, as much as possible, report all incomes that are supposed to be taxed in Ghana, and then take advantage of the special voluntary disclosure program. Okay, John, so that would be it. On the mention of the tax filings, the annual tax filing, it brings me to the 2023 tax filing obligation, right, which is due in April 2024. Now, this is a bit special because there is an additional calculation required. And this came about because of the change in rates within the year. You know, the PAYE tax rates were amended May 2024. And so the paragraph 9 of the first schedule requires that if there's a change in rates within the year, a tentative tax calculation needs to be carried out in order to ascertain the total tax payable by an individual for the year. Now, what this means is that prior to the change in rates, the highest tax band was 30%, but a new tax band was introduced from May 2023 to December. So it sort of carries out a weighting such that the chargeable income is run through both the old rates and then the new annual rates, and then the weighting is done to get the total tax payable. So what we have realized in practice is that if your individuals or employees have high income from January to April, there's a likelihood that there would be additional liability because of the introduction of the tax rates. Yes. So we would just recommend that this tentative calculation is done to ensure that the right taxes are reported for 2023. Thank you very much, John.
All right, Betty, thank you. Thank you. So one underlining point I think Betty stressed on is compliance. So for individuals, ensure you are compliant. For businesses, ensure you are compliant given the changes we have seen in 2024. Beyond these updates, so we had some publications by the GRA with respect to ride-hailing businesses and the requirement for them to pay VAT, vehicle income tax, on a quarterly basis from 1st of January 2024. We also saw a publication from the GRA indicating the commencement of the 10% withholding tax on lotto gross winnings by the National Lottery Authority
All right, John, thank you. So I think I mentioned earlier that if you rent a warehouse and you are not an estate developer, then the flat rate of 5% would apply. But if you're an estate developer and you rent warehouse, then of course it will also qualify at 5% as well. But is it hotel? No, the next is other part hotel.
Yes, yes. So you can add that as well for hotel.
Yeah, yeah. So hotel doesn't come under the flat rate. So hotel is a commercial rental establishment. So the hotel will still go for the standard rate of 15%.
Okay, okay, right. Thank you. So Gideon, there's a question on whether the VAT flat rate applies on non-life reinsurance policies as well. So I'll come back to pick you, but before that, I see Hudu's hand up. Hudu, so if you can unmute and then ask your question. Mutawakel Hudu. So if you can unmute, I see your hand up. If you can unmute and ask your question before I go to Gideon to pick his comment on whether the flat rate will apply to non-life reinsurance policies as well. Yes, Hudu, please go ahead and speak. You can unmute now. Okay, so if Hudu is not ready, let's go to Solomon. I see Solomon's hand up as well. So Solomon, please proceed. You can unmute and ask your question.
John, can someone unmute them because it looks like they are unable to unmute?
Okay, so Emmanuel, can you help unmute Hudu and Solomon? So whilst we wait for that, Gideon, let me pick your comment on the last question I raised. So whether for non-life insurance policies, non-life insurance policies, the flat rate of 5% would apply on those ones as well.
I'm not getting it well. Non-life. So this the amendment applies to just non-life. It didn't mention reinsurance, and so I think it's one of the areas that will need to be clarified. I remembered around 2017 when the scope of what qualified as financial service were amended. It included things like reinsurance. And by this time around, they didn't touch on reinsurance. They just said non-life. So it's something that it's as I said, the VAT Act is very specific, and so if something is not mentioned, I wouldn't want to include it there. But somebody could also sit down and say, well, non-life is not right, whether you reinsured it or not reinsured it. So this is a very practical example of some of the questions that will be coming up. It's just a month now. That will need to be clarified. So I think it's something that we'll pack, and then we would also seek clarification. If you're also already in the insurance company, I understand the Insurance Association is engaging with the GRA on this. So it's a question or a guideline that will need to be provided.
Okay, Gideon, thank you. There's also a question on high net worth person. So someone wants to know who is considered as a high net worth person. Betty, you can assist with that question for me.
Yes. So I indicated that the GRA does not have any set definition, but then they are going by the general finance definition, which says that the individual's assets and income should be more than $1 million US. So that's the threshold.
Okay.
But when it comes to the celebrities or public figures, they don't necessarily have to meet this threshold. They can go after them regardless of whether they meet the $1 million USD or not.
Okay, right, thank you. Solomon and Hudu, are you able to speak now? I see your hands are still up. Okay, Solomon's hand is done now. Erasmus Mensah, I see your hand up as well. If you can unmute and ask your question. Erasmus.
Yeah, good morning, team.
Okay, good morning, Erasmus.
Yeah, so I'm Erasmus Mensah from Aquabrill PLC. Yeah, so on the levies on imported services, I wanted to find out, so what is the difference between the management from TP perspective? You know, we pay management fees, right, for services that our intercompany related party gives to us in terms of assistance, right? How is that different from the imported services that the Act is referring to? I want clarity. Is it that we still have to go ahead and pay levies on those services, or because we pay withholding depending on the double taxation treaty with the country, we pay taxes on those, we withhold taxes on those management fees? Are we supposed to go ahead and charge levies on those services as well?
Okay. All right, thank you. Gideon.
Yeah, so thanks a lot for that question. Yeah, so first of all, I think we would then need to first clarify for your business whether it's really an imported service. The provider is outside of the country, it's provided for your use in the country. And when you take a look at the case, in fact, the judge went through that specifically, and you see a number of the line items are very normal. That's a lot of multinationals pay for, especially management service, other sort of technology assistance, etc., that parent companies provide to their related parties here in Ghana. And you find very similar type of issues. So after that, then we come to the next point, whether the VAT should apply. And then you like, based on the services that you mentioned or your company, I assume you are a vatable company, you charge VAT on your services. So on that, it's then likely, based on the ruling from the court, that only the 6% would apply in your instance, because the judge said that irrespective of whether you are into taxable or non-taxable exempt, the 6% should apply across board. Something that I think I say I'm not in agreement with. And from what I heard, there could be possible appeals, etc. Until then it's appealed. That's what is law now. And I know with the GRA understanding this issue, they will go accordingly and start applying or enforcing what has been stated. So irrespective of the withholding tax issues, you would agree with me, even here in Ghana, there is withholding tax before there is VAT. So those are two different rules, and that's have been applied. So you could have done the double tax agreement or etc. applying it, but when it comes here, it's saying the 6% should apply.
No, so we provide goods. We are a standard rate supplier. We provide goods. We charge levies and we charge VAT as well, right?
Yeah.
So my confusion is the services we are receiving. So the invoice we receive from, let's say, the related party, okay, it forms part of our expense. Now that invoice, are we supposed to now go and calculate 6% of the invoice and add it to our levies we are charging on the provision of our goods we manufacture?
Yes. So that's an output VAT. For that month that you pay that, there's an additional liability of VAT that you have to pay to GRA. Those who would know the previous version of the VAT law as it existed before this 896, we used to have that, but then you pay and then you collect, you pay and then you collect. So with this, it looks as if, because it's just on the levy, the 6%, for that 6% that you are going to pay for that month, you have an additional charge. It's as if the person should have charged and paid here in Ghana, but because the person is not here, you are going to do that additional charging and paying on behalf of that person. So your cost or expenses goes up by that amount.
Well noted. What about a situation whereby the supplier, okay, so let's say I received a service, okay, in terms of for contract terms, it's not a related party. Okay, and the person has issued an invoice to me to pay. Are you saying that one too is my responsibility to add additional 6%? This one, I'm not looking at related party transaction.
Yes, it's, as I was saying, it was imported service. It's not related party. But Erasmus, there are a couple of questions. Let's take this offline and we can talk more about it.
Yeah, so Erasmus, maybe you can reach out to us via mail, and we can deal with that separately. Okay, right. Thank you.
Yeah,
I see Joseph Opon's hand up. Joseph. Joseph, yes. Please, you can unmute and ask your question. Okay, so while we wait for Joseph to ask his question, so Joachim, there are two questions on the VAT flat rate introduced. So if you could pick those ones for me, whether there is a threshold for those in the rental space before they apply the 5% flat rate, and then for landlords who are not registered for VAT at all, what is the implication of the coming into force of this law?
All right, John, thank you for the question. So I guess that the question of the threshold is in respect of registration. So once you meet your registration threshold, so if your 12 months taxable supply exceed 200,000, then you are registrable. So once you are registrable, any type of supply you pay, whether 5,000, 10,000, 50,000, you will charge the tax on it. All right. So the threshold only comes in at the point of registration or determining registrability. Once you qualify to register, and let's take note that it's either you are registered or you are registrable. So if you are registrable, means you are engaged in taxable supply and your revenue exceeds 200,000. It's important, 200,000. If you don't register with GRA and charge, of course, because before you can charge, you need to register with GRA, and then you'll be issued a VAT invoice. That is what you use to raise your invoice for the rent that you are charging. If you have not registered, later GRA can come after you and surcharge you for the taxes that you did not charge. So that is where the threshold comes. John, please, if you can remind me on the second part.
So the second question, which is also linked, was in respect of landlords who are not registered when they're coming into force of this law. What then should they do?
Yeah, okay. It appears I have read those together. If you have not registered, so I think maybe the other question on whether is it an individual landlord should also register. Let's take note that the 5% is applicable in terms of the first group on commercial rentals, right? Not for dwelling. So if you are just renting where you and your family you sleep, that's exempt from VAT. You understand? It's exempt from VAT. Unless it is commercial rental establishment, hotel, hostel, right? Those are the ones that it will be subject to VAT. So if the landlord here in question is giving out his house, his room for dwelling, then VAT is exempt from VAT. But if he's running it as let's say a hostel, you have 5 rooms closer to a school and you turn it into a hostel. If you estimate your annual income from the renting and it will exceed 200,000, then as a landlord, you are required to register for VAT and start charging VAT on the hostel fees. This time at standard 15% of flat.
Okay, Joachim, thank you. So I see we still have a few hands up. Frepon NP, Ali Iliasu. So any of you can unmute and then ask your question. I see Frepon NP. Yes, so Frepon NP, you can unmute and ask your question.
Hello. Hello.
Hi, Frepon. Yeah, please go on.
I'm Ali Ilias. I'm joining from Dubai.
Okay, Ali.
Right. When I used to be in Ghana, I used to work with a company. We used to pay the standard rates. We rented the warehouse, but we were paying the standard rate for VAT. So I don't know how this 5% is going to impact on this standard rate we're paying for the warehouse. Is it that we should expect a change from the standard rate to the 5%, or we should still expect the standard rates?
Okay, Ali, thank you. So as we earlier mentioned, with the coming into force of this Amendment Act, the invoices for the warehouse rental now should be subject to VAT at 5%. So we'd expect the landlord to now issue the invoices with VAT at the rate of 5% and not the 15% you used to receive.
Okay.
Okay, I see Hagar Offer's hand up as well. Okay, Frimpong, you have unmuted, so you can ask your question. Frimpong MP.
Yes, can you hear me?
Yes. Kindly speak up a little bit for us.
Okay, can you hear me?
Yes. Yes, it's better now.
Okay, so my question is with regards to the realized and the unrealized FX. Last year, as in 2022, we made huge FX losses. So a greater portion of it were deferred. And that portion, we have to amortize it over 5 years, both realized and unrealized. So my question is, right now that we are saying that they are going to allow only the realized. What about the one that we deferred 2022? Are we going to be allowed to use the 20% of it in the 2023 financial year in the assessment of our CIT?
Okay, all right. Thank you, Frimpong. And so Joachim will pick that for us. Joachim, if you can help respond to Frimpong's question, yes.
Okay, all right. So thank you for your question. So one thing about the exchange different laws or financial cost restriction, let me put it that way, is that when you carry it forward to a situation for any year that is carried forward, it is being deemed as incurred in that year. All right. So you have 2022 carry forward 2023. It is being deemed as incurred in 2023. So it will be subject to the same rules as applicable in 2023. That means that it is only the realized portion that can be subject to deduction. That can go through the deduction slip to see how much more you can deduct. It doesn't mean the realized portion, you can still keep track of it. Once it becomes realized, then we can now continue to deduct that.
Okay, thank you, Joachim. So I see Hagar Offer and Shaibu. So if you can unmute and ask your question. So Hagar Offer and Shaibu. Hagar Offer and Shaibu. So if they could be allowed to unmute, then they could ask their question. Okay, so whilst we wait for them, there's a question here. So someone was asking whether the 5% flat rate would be charged with the COVID levy, as we have in the case of the 3% flat rate. Gideon, would you like to speak to that one?
Yeah, and that's what we said. We are now looking for guidelines because it looks like that's what they did for the 3%. Maybe they might do that on the 5%. We don't know yet. It might come up with the guidelines because the law wasn't specific, and then nothing showed us how they haven't played their hands yet. So it's something that we'll still have to watch out and see what the GRA says at the end of the day.
Okay. Okay, thank you, Gideon. We're running behind time, so maybe I'll pick one more person who had the hand up, then we can proceed. For those with unanswered questions, you can drop them in the Q&A chat box. We will put them together, provide responses to them, and share them across. So I see one with the name Crown School. If you can unmute, you can allow him to unmute, him or her to unmute, and then ask the question. Crown School. So Emmanuel, can you allow Crown School to unmute and then ask the question? Then we can have good news also ask the question. We can pick these two. Then for the other questions, we can put them together, provide responses, and share with the participants. So Crown School, you can now unmute and ask your question. Okay, so if Crown School is not ready, good news, you can unmute and ask your question. So that can be answered before we proceed. Good news.
On mute.
Yes, we can hear you. Please proceed. Good news. Please proceed with your question. I'm sure he's having challenges. Okay, so this is what the time would allow us to take. For any unanswered question, please put them in the Q&A chat box. We'll put them together, provide responses, and then share the responses with you. And allow me to share Deloitte School of Tax 2024 training calendar with you. So for the 2024 calendar year, these are the trainings we have lined up from now to the end of the year. And it will be good to have you join us for any of these trainings. So block your calendars, make a time, join us. Let's have educative sessions while we work through these interesting tax and regulatory topics. So on the 27th and 28th of March, we're having our corporate income tax masterclass. We have the IFRS 7, where we look at the convergence of accounting and tax principles, given that we have IFRS 17 in place now in April. There will be a tax training for non-profit organizations in June, and we have one on corporate governance on the Ghana's companies income tax lined up for July through to the last one in December, which will be on VAT principles on and compliance. Also, to get access to up-to-date tax news, we advise and recommend you download the Tax at Hand app. So you can get tax news from Ghana and the rest of the world on the Tax at Hand app. You can scan the QR code we have here to download the app, and you'll be able to get an up-to-date information on everything tax happening around the world. Thank you very much for joining us today. It's been an educative session. And thank you to Joachim, Gideon, Betty, and Na for sharing your views and thoughts with us on the key amendments and then what the tax and regulatory landscape looks like within the 2024 calendar year. So whilst you leave us, we would like to hear from you. You can scan the QR code and let us hear from you, your review comments on the session we've had today. And for those with unanswered questions, we'll put those questions together, provide responses to them, and then share them with you. Thank you very much once again for joining us, and do have a good rest of the day. Goodbye.
Bye.